Well, hi everybody. It's Keith Richards here from ValueTrend, and this is our third webinar of the series that we've been doing for the good folks out there in webinar land. And this seminar was one that we were kind of looking forward to. It really focuses more on specific techniques to find adequate stocks and how to identify stocks that are suitable for buying. And we're also going to focus a little bit on the breakdown point. In other words, where you might want to consider selling a stock. So a lot of people ask me on the blog and in my seminars, how do you know when to sell? So we'll try to address that a little bit today too. We're focusing on one particular style of stock picking. It's one that we use a lot here at ValueTrend, and I mean there's kind of trend following, and then there's kind of consolidation breakouts that we look at, and we're going to focus more on the consolidation breakouts today. And the reason we're going to spend a bit more time on that is because consolidation breakouts are one of the most powerful tools. You can, when you get a breakout from a consolidation, the move can be explosive. It's often better than just buying into a trend from a return perspective. So I thought this would be an interesting seminar for you guys. And I'm actually asking Alex Bozek, who is my intern technical analyst here at ValueTrend, to conduct the seminar. And Alex has been developing, kind of techniques to screen through stocks on the market and find breakout candidates. So I thought it would be a good fit for you guys to hear from Alex, and then there are some question and answers at the end. Now, this is a recorded seminar right now. We did it live, so there were some question and answers that we were able to do live. I'll note at the end of this seminar, you'll hear that there is another one coming up, another webinar in March, and that's going to feature Craig Aucoin, who is a fundamental analyst. And I know a lot of people listening to this will be technical people because a lot of you will read my blog, but fundamentals definitely matter, as you'll hear, because we talk about that, in the seminar. Like, when a breakout occurs, you need a catalyst, and that's usually a fundamental catalyst. So without further ado, I will bring Alex into the picture. Okay, take it away, Alex.
Hello, and thank you for tuning in to ValueTrend's webinar here. We're doing a re-recording of this one as we had some technical difficulties last time. And this one's going to be finding breakout setup. So breakouts are probably the most powerful technical tool that we have. We discussed last week about consolidation, some basic technical patterns. Now we're going to go more in depth with some breakouts. So a disclaimer, anything that we'll be talking about today will be purely educational. The contents are for information purposes and do not represent investment advice. So we don't know the future, but we can certainly increase our odds of success. So true market timing is when you weigh the risk and reward of owning a potential security. So if we're looking at a breakout, which we're going to be looking at later on, once it breaks out, we'll be looking at what is the risk of the potential risk of the breakout, whether it's a failed breakout. So we'll outline a few of those things. So what is a consolidation? So consolidation, as we discussed last webinar, but you have resistance up at the top. It's where the buyers can't push out the sellers. Support is when the buyers step in and they outweigh the sellers. So basic consolidation. Now we're going to be looking at what happens when buyers come in and break that resistance. So what is a breakout? Breakout's very simple. As you can see in this formation, triangle, as we get closer to the apex, we break out. Down below, we have a bump in volume, which confirms the breakout. So now let's compare breakouts and some consolidation. So Kinaxis, so K XS on Toronto was in a consolidation from May 2017 to around November 2019. We can see up top, resistance was around $100. Down below, we had support around 63, 60 bucks. Now, what happens when it broke out? So as you can see here in January of this year, we actually broke out. So we broke out to 109 bucks. We came back. So sometimes most breakouts get retested at a certain point. However, here in a couple of weeks, we came back all the way to 98 bucks, and then we continued making a higher high, which we want to see. Now we'd possibly look down for a higher low, and then we would be in a continuation potentially of the uptrend. We have the 40-week moving average or the daily 200-day moving average sloping up, which is very positive. So we're going to take a look at a few more examples. So DSG on Toronto is consolidating in a long-term uptrend and then breaking out in January of 2020. So this is a technical pattern that we'd like to see. So we have an uptrend, and then we have a consolidation for here it was around 5 or 6 months, and then we break out as we have a rising 40-week or 200-day daily moving average, and we are on our way to making higher highs and higher lows. So the breakout is a very powerful technical signal that we have, and it represents opportunity for risk management as well. So if we see a breakout above, let's say on DSG here, around $54, you can see that, well, so we're looking around 54 as our stop. In this case, it came down to 52, so not exactly, but around the 50 level we'd be looking at as a potential stop. And then your upside, what you can do is you can potentially look at what the range was of that box. So here we were of the consolidation that we were in. So we were around 56 to 44, call it 12 bucks or so. So if you take that 12 bucks and put it up top to where we broke out, that you can use as a potential target, near-term target on a stock like DSG. So breakouts are very interesting, and they offer a lot of potential risk management tools that you can implement. So now when we're looking at GEI here, Gibson Energy, and it's a Canadian energy stock in an uptrend. You don't see that too often. So what we had in GEI here was actually we've been consolidating for quite a while. We've seen 4 years of consolidation. We had a top around 21 bucks and down below 13, so call it 8 bucks or so. And we did fall through in 2016, but we came right back up, which was indicative of also the 200-day moving average acting as resistance there. But what we've seen now is in 2019, actually, we broke out. We broke out of this around 22 bucks. We came back. We had the 200-day moving average, or the 40-week in this case, as support, touched back there, and it continued on making higher highs or higher lows. Higher highs and higher lows. So what we can also take here is, like we discussed on DSG, if we were to take what the box width is, so from 21 to 13, we can say, well, hey, potentially we are close to our first target, which would have been around $28. And necessarily that doesn't have to be a permanent target. Stock can continue going up higher potentially, but it's very interesting that it's one target, again, how we were talking about risk management, that we can use. So if we take a look at some of our selling disciplines here at ValueTrend, we sell upon a break of an established trend. So if we see a lower low and a break of the 200-day for 3+ days, we don't necessarily, like we've seen in these previous charts, we can see these candles that come all the way down, but they only stay for a day or two. So we want to see a break of a truly an established trend. So established means that it didn't happen overnight on 1 or 2 trading days. We want to see it for at least 3+ days. We also want to sell when a security is broken down from an obvious topping pattern. So we'll look at a few in the next few slides, but we're looking at, so what happens if, for example, on Gibson, if we go back here, when Gibson broke down from the consolidation it was in, around 12 bucks, it probably would have been a good risk management tool to look to to reduce your holdings potentially in something like that before it went all the way down to $9. So that's what we also, when we talk about topping pattern or consolidation, we want to see when a stock has broken support. So the prior low, and it's taken out for 3+ days. Again, not just one day down, we want to see it for a few days. Then we also want to talk about when we sell when a security reaches a target. So like we talked about in GEI, potentially using the box, the resistance of the and the support, the box difference there. So on GEI 21 down to 13. So we want to look at something like that and we calculate, well, hey, if it's already reached our target here of close to around $28, do we want to maybe look to reduce some of our holdings or implement some potential risk management tools? So we also, our final one here is that what we look at is we want to sell when a security, like we said, breaches support for 3+ days. Now, what happens when a breakout turns into a breakdown? So if we can see here on ANGO broke out from very tradable potential range that we've talked about in previous webinars to 18 to 14, so $4 trading range. It broke out, went all the way up to 23, 24, went up to 25, but as you can see, we then started making lower highs and lower lows. And we had that 200-day starting to act as resistance. Once we see the 200-day moving average acting as resistance, we want to be significantly worried, and we want to potentially sell on givebacks up to that 200-day moving average. Now, if we look at ANGO, we broke below what was previous support around 1480, and again, we're making lower highs and lower lows. It shows the importance of here at ValueTrend how we implement fundamental analysis, which we'll be talking in later. Our next webinar, our resident CFA Craig O'Coin will be talking about how he takes a setup like ANGO and says, well, hey, are the fundamentals good? Can the fundamentals support the breakout? In this case, as we've seen, it supported it for a few months, but looking at some of these candles, we can tell that the down candles look to be news releases, earnings reports. So again, that's a really important part of our aspect here at ValueTrend, is that we have that fundamental aspect where we can take a technical breakout and determine whether is the breakout going to last, does it have legs, or does it have the risk that we can see in a name like ANGO. So now, how do we find these breakouts? So we've developed a quantitative scan for ideas here at ValueTrend, and we scan for both the Canadian and U.S. listed securities. These scans help us find all of the formations that we will discuss below. These scans help ensure that we're always, that ValueTrend is always generating the best ideas for our clients. And we can take a few stocks that we, from our U.S. long scan these last few days. So this is an example of what we get. So we get 38 results, and as we'll discuss later in the webinar, if you were to do this to yourself, potentially the results you would get around is 200-300. So we've significantly reduced the amount of results that we get, but the results that we get are all quality breakouts. So it reduces the time for us to go and look for each setup when we can just have a quantitative scan like this. So now let's look at Ameriprise Financial, AMP. So what we have here is what we like to call a rounded bottom breakout. It's a funny name, but what essentially it is we have a top here that we've seen in AMP, in January of 2018, came all the way down to $92, then it finally broke out. So if we were to draw that, it's a rounded bottom there, and we finally break out above that 173. Now again, we want to determine whether is the breakout legit, does it have legs, and this is again where ValueTrend implements the fundamental process towards this. So now if we take a look at ITW, a similar setup as a rounded bottom breakout, what we also have here again, and what we want to ensure on a breakout, is that we have multiple candles that support multiple days, and in this case months, that have passed of the stock breaking out above 169. So what we also have here, and what we've highlighted in some of the past slides, is we did retest a few times, and if you can look at the retests, all the retests were fairly close to that 169 level from where we broke out. and now we're on our way to making higher highs and higher lows and potentially resuming the uptrend. So the key when we're looking at these breakouts is what we want to determine is whether we can see a potential another uptrend like we saw in ITW from 2016 to 2018, where we can use the 40-week moving average as almost a stop loss essentially and continue to ride the trend. So this would be an example of something that we want to consider here, whether it's just a 1 candle or 2 candle breakout. In this case, we can see that potentially it's a resumption of an uptrend that we've seen in the past. So breakouts come in all different formations. So we talked about a few rounded bottom breakouts. Now we're going to take a look at Netflix, which is a downtrend breakout. So Netflix was, as we all know, in a great uptrend from 2015 all of 2018. We topped around $400. We had a move down. Stock really didn't do much. Now, if we take a look at the top of our trend line that we've drawn there, we can see that we made lower highs and lower lows, but we finally broke out of that formation recently. And if we take a look at the closer chart, we can see that Netflix is in a steady uptrend. So this is, again, another type of breakout. So we can draw that top trend line on those price labels there on the top of those candles, and when we see a breakout, like in Netflix here potentially, we want to see whether this could be a resumption of the uptrend that we had in 2015 all the way to 2018. And we can also see that the 200-day or the 40-week moving average in this case is starting to slope up back again. It was from the consolidation, you can see it wasn't really doing anything. Now it's starting to slope back up again, and this is something that we want to see. So now how can you find these breakouts? We'll go on stock charts. Okay, so we're here on stock charts, and as a disclaimer, we have no paid affiliation with stock charts. We only use the program and the software for our own and to find these stocks. So looking at stock charts here is they have a tab. Now when you have a membership, you look at tabs, it's called predefined scan results. So here if you have a membership, they offer these predefined scans. So what we're looking at here is we can look at this one, and this is the easiest scan to use for if you don't want to create your own and want to get too technical. But the issue with the scan like this, as we can see, is it's the move above the Bollinger Band. So we'll discuss I believe we also discussed in the last webinar, but in the next we'll do a more technically advanced webinar later on. But essentially, what the Bollinger Bands are is they're bands that from a stock. So if we're looking at the sideways of consolidation, so the top Bollinger Band would be the top of the range and the bottom. Now, when they get together and they expand, that's essentially what creates a breakout. So what here is, you can see, so on the NYSE, you have 88 stocks that are moving above their Bollinger Band, 63 on the NASDAQ, 12 on the TSX, 16 on the Venture, and so on. But what this essentially shows you is the mass of these breakouts. Now, sometimes breakouts on the ones mentioned here don't fill some other criteria that we look at, such as relative performance and certain metrics. So yes, you can use this, but what the scans that we've created for clients and for our platforms essentially is reduces that almost, let's say, 200 or so names down to 20. So and those 20 all fill our criteria. Most of these probably wouldn't fill our criteria. So it essentially saves us a lot more time. Instead of looking for stocks like this, we can use the time much more effectively on certain other things. So it's a great way, what we've done here with the scans and creating a way to simplify the solution. So let's take a look at, on the TSX, we'll just take a look at these 12 quickly.
Alex, I'll just break in, and just for the listeners, you can use that scan, the black box scan that Stock Charts has, and then you can add your own filters. So that's effectively what Alex is saying, is we've taken that scan and we've doctored it a bit to refine out a lot of the names that are of no use. No, we're not going to provide all the processes that we use to do that, because obviously that's our bread and butter. However, you can, as a technical person yourself, there'll be certain factors within that scan that you could add that will help define more of what you want. For example, you might add a filter around a moving average. You might add a filter around some sort of a momentum indicator, etc. So just it's a good base though for you guys that are listening to start with. That you have to have some sort of process that here's where I get my ideas. So anyways, carry on.
Yeah.
So.
And we'll take a look at, for example, so Canadian Tire here. So looking at the chart here is we can say on Canadian Tire that maybe potentially it's broken out, but if we can see that candle, it's broken out and then come right back up. So there's a lot of resistance in this area around 150. So again, this probably wouldn't, actually looking at some of these indicators, this wouldn't have popped up on one of our scans. They would have filtered out the information and provided us that this doesn't suit the criteria that we're looking for. Now, however, here, if you go on, setup will take, let's say, Barrick. We can take a look and you can draw the trend lines, breaking out, define your risk. So it has its benefits here looking at predefined scans, but it should be more or less just a starting point, and there's quite a lot more to do. And that's why what we've done with the scan. So we'll go back to the PowerPoint here. Oops. And we did a great blog. For example, I know most people probably aren't interested or don't have a brokerage account that can trade Bitcoin, but what we've done is we've had, one moment, let me just, okay, let's do that. So what we've done is we've essentially created, we wrote a great blog about how Bitcoin is actually has somewhat of a correlation towards the overall market, and we give some examples from one very high name in the industry and how he's talked about the relation to Bitcoin and the overall market due to risk sentiment, and you can check that blog out on ValueTrend.ca. And Keith does a great twice a week. He tries to do a blog twice a week, and it's really great educational stuff. It's a blog. It's not a way that it's not salesy at all. So it's just a genuine blog. And I know most of you tuning in today to listen to the blog, and on our website as well. On the right-hand side, you can also check out our newsletter. So if you go on, you'll see a tab. It'll say sign up for a newsletter. It's a free newsletter. Try and do one occasionally. We actually just sent one out today. So it's a great way to also get more content from us. And you can follow us also on social media, the blog's there, YouTube, where this presentation will be posted. We'll edit it out, and again, we apologize for the start there without the screen, but we'll make sure that the YouTube one is a completed version. We also have a Twitter where we post everything that's going on with ValueTrend. If we're presenting anywhere, if we're doing, and the blogs. It's overall a great hub to stay more connected towards good content. So if you're interested in ValueTrend's investment process, you can give us a call toll-free at 1-888-721-8736, or you can email me at abozic@valuetrend.ca. And again, we'll also send out a Survey Monkey at the end, just letting us know your feedback, your response. And we do obviously know, and we apologize for the start with the audio issues, and again, with the video issues, and we'll make sure that doesn't happen. It's still fairly new certain things to us, so we're experimenting that. But our main goal with these webinars, what we really want to do is have a lot more content.
Do you want to go to questions now?
Yeah, so we'll just quickly do this as well. So our next ValueTrend webinar actually is going to be done by our resident CFA, Craig O'Coin. He's going to be doing a presentation about ValueTrend's fundamental process, which I think all of you should tune into. It's going to be a great presentation. We've offered a lot of technical insight. Now, how do we apply that technicals with the fundamentals? How do we par the two up? So it'll be great. Again, we always do this, but it's really good content. If Keith's two books, Sideways is the really technical one. If you were interested in some of those consolidation setups, Keith talks about that in the book Sideways, and Smart Balance is more of the portfolio book. But we'll go over to questions now. So if you have a question, you can type it into the chat box, and we'll do our best to answer your question.
Is this only now showing? There we go.
Yeah. So one question is thoughts on the Canadian energy sector.
Well, I'll answer that one. We actually just bought today a small position. We had a very small position. We bought a couple, I guess it was maybe 3 weeks ago, but we just really only wanted to dip our toe in. The seasonal period for buying energy is right now. Interesting, if you look at the pattern on oil, on
Here, we can pull it up.
WTI oil, you will see that it is near the bottom of a trading range. Since Alex was talking about
US
that earlier.
The United States one. That's kind of...
Yeah, so you can see there's the trading range, and you can see exactly where it is. Alex, you put the marker over to just to show people it's right there. So so we're buying off of that. It's a white candle. We're early again. We just leg in a little bit at a time. So we bought one stock, and we bought an ETF that just represents the oil itself. Seasonally, oil is good usually from around the 20th of the month. I think it's like the 18th to be exact, but whatever. Somewhere around the third week of the month in February, and tends to go very strong until May. So I think it's a good setup, and where we would trade it is probably at the top of that range, which you can see in this particular chart. Okay? So go back to the questions.
So looks like Waste Connections has broken out recently. So
yeah, we own it.
Yeah, so we own Waste Connections, so we'll show a chart of that. So Waste Connections, so we had resistance here around 128. As you can see, we've broken out. So
yes, so it's broken out. We already owned it. We didn't figure there was a lot of downside when we bought it. We bought it as a defensive stock. It's in the garbage business, and it's one of those businesses that it's just never. It's always going to be garbage. But you need some earnings. You need some impetus to make it break out. We did not buy on the breakout. We bought it earlier. It's rare for us to do that, but in this case, we were kind of taking just a bit of a defensive stance, and it just so happened that this is where Craig comes in, and maybe why you'll want to listen to his seminar next week, or next month, I should say. Craig was a believer in this company, and sure enough, the earnings just came out. I think it was yesterday. I'm pretty sure it was yesterday, and stock popped. So it's so now really the setup is, because it's broken out. You can see that in the past, whenever it's you get. Sorry, I'll borrow this, Alex. You can see that you'll get periods of consolidation, like here on the stock where it did nothing, breakout goes up. So here consolidation, breakout goes up. So we kind of feel that maybe this will have a few bucks ahead of it. So we're bullish on the stock for now, anyways.
And this would be the breakouts that we were talking about. So this would be the downtrend breakout. So off the moving average and a move higher. So that's good.
Okay.
So we will see. Oh, we can't see the chart. Let's see. Oops. Let's see. Okay.
Go back to the chart, Alex. I think they wanted to see the chart. Yeah.
The waste connections?
There's the waste connections.
Yeah.
So hopefully everybody can see that. So you can see the breakout, and yeah, you can see the times it has consolidated in the past. It's been bullish.
Yeah. So breakout above 128 on that. And so do you provide breakout stock service or any other membership services like that?
No, what we're trying to do here is maybe provide a bit of education on how to identify them, and read my blog, because I do this. I talk a lot about breakouts on the blog. But no, we don't. We're not in the business of sending out research or selling a newsletter or something like that. We're portfolio managers, so if you want us to provide you with portfolio management, that's what we do, and we're happy to talk to you about that. You can contact Alex, and you can always set up a personal conversation with myself and Craig, who are the portfolio managers, on the phone, and we can talk about your situation. But we don't sell research. That's for other people to do.
Yeah.
Okay.
So maybe with if you can't see the charts, and you can see it, some can, some can't. Could be your internet connection with some of the lags, but
somebody asked.
Yeah. So,
okay, there's been a lot of questions here. So let's rip through them. So when do you decide if a chart failure? Okay.
A&W, so we can maybe pull that one up.
So we can look at A&W. Okay. Somebody was asking about A&W. Hopefully you'll be able to see the chart.
So we can probably.
Is that A&W?
Yeah.
Okay. So I don't remember being on talking about it specifically on BNN, but I guess what we saw here, and actually, Alex, I'm going to come around.
Okay.
So I mean, again, it's BNN, and the charts kind of suck, but quite probably what I saw was this, and again, how long ago did I make this call? I don't remember. But this was a consolidation, and it broke out to the downside, and you can see that. Sometimes it could have broken out to the upside, but it didn't. It broke down to the downside. So really now it's consolidating again. So I would say at this moment it kind of looks like a sideways stock again, just like it was here. You don't buy because it's not a big enough trading range. Like unlike oil, which has a very defined trading range, this is pretty tight. So I probably wouldn't. I wouldn't buy or trade this stock unless it broke out definitively. It's a pretty rough-looking chart, to tell you the truth. I don't think I'd be involved with this. So, okay, let's hit the next question, because we want to get through the questions.
Okay.
So the next one was...
so it was this.
When a stock breaks down below significant support, do you tend to wait for a retest of the support before selling, or just sell it right away? So, yeah, I do tend to wait for a retest. So, I mean, it doesn't always happen, though. So just be aware that I'm always taking my chances, and I've got good stories and bad stories about that. Bad story was a couple of them. Both I had chart breakdowns on good old S&C-Lavalin, our Prime Minister's favorite. So that broke down and didn't retest, and so I kind of had to just sell as it tumbled. I sold early enough to not, it went down a lot further, but it didn't help me to wait and see if there was a retest. The other one was Cineplex about a year or two ago, and it did the same thing. It just waterfalled. I call it waterfall. Didn't retest. Okay. So, but most of the time they retest. Okay. So the last thing is they said. Somebody, I think we already answered this.
Yeah, about oil?
About oil. So what are my views on energy, and do I see an entry point? Yes. we just entered today. So, I mean, we tend to leg in. So just to let you know, like, you know, if we want, say, 7% in oil, which I do, I think, 7 or 8%, we don't just jump in and buy all 7 or 8% today, you know. So we bought a little bit a couple weeks ago, we bought a little bit more today, and we'll probably buy a little bit more if it starts moving up the way we think it will within its range. But seasonally, it's time to buy oil, and technically it looks like it's bouncing off of that $49 support level. So we're taking our chances in buying some. Comments on Merck. Sorry, where's that?
Yeah, so your comment on Merck, which is broken.
Yeah. So you're right. We bought Merck. I mean, we have like 25 stocks in our equity platform and 30 odd stocks in our aggressive one. So Merck, we just bought it and then it broke down immediately. Murphy's Law, right? So let's just, okay. Hope everybody can see that. You can probably see why we were buying this. It did a little consolidation. It broke out. We're always looking for breakouts. It tested the breakout point right here, and we liked those tests, so we bought it like right around here, which was about 85 or 86 bucks, probably 86, and then it broke. Okay, because earnings came out, and so we're now in the process of, you know, we're going to give it another couple days or so, but if it doesn't pick up by next week, see, it has done this before. Like, it's pulled back hard. It is a drug stock. You got to remember that. It's pulled back hard and then off to the races, right? So, you know, you do have to remember that there's another pretty strong pullback and then up it went. So drug stocks do this. But having said that, I'm not going to wait around forever, so I'll probably sell it next week, but that is a stock. Clearly, this is a client who is asking this question because I never announced anywhere that we were buying Merck, but we bought it, and we'll sell it if it does. Like, we're really one bar. This is one bar, which is right now less than a week into the breakdown. If it lasts, into next week, then I'll probably sell it. So hopefully that makes sense. So let's go back to questions.
So oil will base for some time.
I mean, that's a question I can't answer. Yeah. I do know that it's basing, and I do know that it seems to be moving between roughly 50 and 60 bucks. I mean, that's just roughly. But so I'm picking it up at 50 bucks. I might make 10 bucks if I'm lucky on it, and I'm really not here for a long time. I'm here for a good time. So it's good to trade.
So a good question. This is actually really good. What is the period that you look at? You look at a stock to say it's broken out. Is it 1 year, 2 year, or less? So
base period?
No, breakouts. So what's interesting about breakouts, we didn't go into that much detail, but breakouts occur on all different timelines. However, what we've done, and due to the investment style that we have, we'll look at weekly charts. So there's an old saying, the bigger the base, the better the case. So, the more a stock is based and it finally breaks out, the more anticipated potentially that breakout has been. So you can look at it from multiple, but weekly breakouts are quite the most interesting.
Like, good examples of that actually are the pipeline. Yeah. So if you look at PPL, which we do own, we'll disclose we own that. So somebody can give us hell about buying Merck, but you can't give us hell for buying PPL because it's done well. But so you can see that PPL, we bought that on the breakout, and take a look at what it's done. Like, it consolidated for, what's that, Alex? Like, what's that sideways period?
48, 49.
Yeah, but how long was that?
So that was 6-7 months.
Yeah, so it was a good long period of time that it went nowhere, and then it broke out, and now it really does look like it could go up quite a bit higher. So that was the 6 months, but there's been some...
Enbridge.
Was it Enbridge?
Yeah, Enbridge was a big base.
It had a big long...
Oh, here's the U.S. version. But
okay, so the same thing. Okay, yeah. So the Enbridge. So you can see with Enbridge, the stock went sideways for a long time.
Yeah, almost 3 years.
And then it broke out. So that's a powerful breakout. Now, it does have some old resistance coming up, but whatever the case, there is a saying that goes, especially if there was no old resistance. Now, Enbridge has some old resistance, but you know, if you do find a stock that's been going, like it took out a lid that has been in place for a year or 2 years, that is massively powerful. So a good example of that was Microsoft a few years ago. We bought Microsoft, but Microsoft had literally had a 10-year base. Like, you just don't find those very often, but when it broke, it was powerful. Actually, even Tesla. I mean, I hate to talk about Tesla because I think it's a goofy stock. Actually, look up Tesla. This is just, it's a good example of stocks that, is that Tesla?
Yeah.
Okay, so look at that. I mean, if you bought Tesla in 2017, and then you looked at your portfolio at the very beginning of this year, if anything, you were down, if not flat. I mean, that is like 4 years of 3-4 years of sideways. So, but man, when it broke out, look what it did. Now, it's a bit, let's face it, it's parabolic. It's just plain goofy right now. But I mean, you can't argue with the fact that when it broke, it went nuts, and it had all kinds of opportunity to break out in the past 4 years, but it didn't. And in fact, if we go back to the years prior to 2017, from around 2000,
so we can take a look at 20 year.
Yeah. So if we go, like, it won't have 20 years, but
10.
But you can see prior to that, from basically 2013 to 2016, there was another sideways period. It broke out, but then it petered off. This time it broke out and it went ballistic. So really, you could say the base on Tesla probably started really in 2013. So from 2013 to 2020, we're talking 7-8 years. So, like, I mean, I'm not endorsing Tesla because I just think it's out of control, overbought right now. But, you know, it could very well pull back like 20% and still be in a great buying position. You know, if it pulls back to the old neckline, which might bring us back to about the, you know, $400 or so, right? So 360 or so. So, but so there's no absolute rule for how long you wait, you know, or how long the base has to be. But the longer the base, the greater the case is a pretty good rule, because we didn't show you the Microsoft chart because it's a pretty big chart, but we bought Microsoft 4 or 5 years ago on the breakout, so you need like a 20-year chart on this.
Yeah.
So you can see this giant base, and it really went on and on and on, you know, and literally through all of the 2000s, this Microsoft could not break, you know, like $30. And then boom, it broke, and it's been one of our top performing stocks since. Now that is a big base. That's a 10+ year base before it broke. Now it's a little parabolic. We actually, our position went from a 4% position to a 7% position just on the fact that it outperformed the rest of the portfolio, so we've pared it down to 5 just the other day. But, you know, it's been a great story, and I could probably, you know, we could keep naming stocks like that. They're sometimes it's pretty hard to find a base like Microsoft, I got to admit. But there's lots of stuff like Tesla and Pembina that we just showed you that we do own right now. You know,
it's because there's so much. It's almost like it's a funny reference, but it's like you almost take Mentos, you put it into Coke, you shake it, and then it finally explodes. So it's just there's a lot of tension and a lot of it's moving in. There's all this tension, and then when it finally breaks out, it's a path to in most cases to the least resistance. While you had something that was so tense, and now it's finally expanded up. So it's a very powerful technical signal to incorporate. So
okay, so
hopefully
that covers most of it.
What is the criteria that you use when to sell after breakout? So we mentioned that in the PowerPoint. We'll quickly pull that up in case anyone didn't see that.
Make sure they can see the screen.
Yeah, I'll just go like this. So we talked about this briefly. It's a break of an established trend, so a lower low, break of the 200-day for not just a short period, but it has to be a significant break. When the security has broken down from an obvious topping pattern, so let's say it's consolidating, then breaks below, like we were talking about with Gibson, we use that example. If also reaches a target, like we've used, talked about Gibson and other stocks. So
one other time, and that is, so if you look at let's talk about Tesla. I mean, I like it because it's very much in the news, and I don't like the stock right now. I got to make that very clear. The stock is just goofy. But if that stock, I think support was something like the old resistance point was somewhere around, what was it, $600 or something, right? So if yeah, so it was, what is that, Alex? It's about $400.
Yeah,
less than $400.
Yeah, 380.
Okay, 380. Okay, so yeah, so it's actually 366. So let's call it 370. So if the stock breaks 360, 370 again, and it's quite a bit above that right now, but let's say it did do a pullback, which I very much believe it's going to do. I don't predict it's going to pull back to 360. Okay, but it'll pull back. It'll probably pull back to $600 or $700 at some point. So whatever that number is, doesn't matter. If it broke 360, then now you've got a violation of the old breakup point. Now remember, old resistance becomes new support. This is like technical analysis 101. Because the old sellers now become new buyers. They wish that they had held on if they sold. So if it gets back to their old sell price, they rebuy. Okay? So that's just one of the psychologies behind why old resistance becomes new support. So that's another sell rule. So yeah, if the uptrend is broken, we probably in this case sell earlier, but I mean this one is a crazy stock to try to look at, but it is a good example of a good, the lid is very predictable at $360. That's the old lid. So that is definitely massive support. Now, clearly, you don't want to watch a stock go from 800 to 300. You know, but so you would have to have a tighter stop loss, probably using, you know, the 200-day moving average, and it's just so parabolic. It's a goofy looking chart. So I really can't even understand this pattern. Like it's like looking at Bitcoin a couple of years ago. So.
Yeah.
But anyways, okay. So
STN, Stantec.
Okay, so I'm gonna just.
Yeah, we'll zoom through that one. That's basically another big base breakout. Yeah. It's overbought like crazy now. So again, it would be potentially something for the pullback.
That's right. China, we just sold. I'm gonna just rip through these because we probably should wrap it up, but. China, somebody's asking about China. My thoughts on China versus the virus outbreak. So we're not fundamental people, but I did do a blog, and I've been harping on this. And, please read the blog on the China virus thing. I wrote it 2 days before the WHO, not the rock group, the WHO, the World Health Organization, did their announcement that it was considered a international crisis. The research that I read from both Goldman Sachs and my friend over at Don Villu. So John did a piece that the last two viruses were literally, the bottoms came in right on the day of the WHO announcement. Well, the WHO announcement came out 2 Thursdays ago, and it was Friday that was the bottom. So I noted that on the blog. I noted their research, and sure enough, I wrote that blog on the Wednesday, and by Friday it was the bottom, just like the research shows. And the research from Goldman Sachs shows that, like, literally, markets are almost 100% positive within just after a month after these viruses. And they talked about SARS and Ebola and AIDS and every other thing you could think of. Somebody said, "Would you want to watch? Really want to watch it again?" Yes, we will re-record this. I mentioned stop loss for the level and to get breached. Yes. So when I say, like, just to clarify, Alex, I want to explain what we mean by stop loss. We don't use physical stop losses because this person is saying exactly in their comment what happens, which is evil traders. No, they're not evil. They're just there to do their job. But traders will take advantage where they think. Sometimes they can even see your stops, but they can definitely guess where retail investors will put their stops. And they actually will drive a stock down that 50 cents or whatever to get it there. So the retail guy gets flushed out. They get to buy more stock at that price because they know it's there. And then, boom, the stock goes back up. So that happens so often with physical stops. So that's why I use my 3-day rule. Okay? Don't use physical stops. Just don't. Okay? you can use a price. If it's $10, put your mental stop at $9.90. That's where support is. Then watch to your $9.90. If it breaks, then count a couple days, and then sure, sell. Okay, but if you put in a physical ticket at $9.90, you will almost invariably get scalped.
Yeah, there's also there's a good thing, just quickly. It's called the volume weighted average price, the VWAP. You can do there's a lot of stuff on Google and you can use it in your charts, but essentially it's where the most volume occurs at a certain price, and it tends to be a good place where these big institutions, and that tends to be where people put stop losses. So there's a lot of stuff to go, but I think it's a good way how we've explained our process of selling. Okay.
Well, thanks, folks, for tuning in. And our next month is going to be Craig LeCoin, and he's going to, I'm the technical guy, but Craig's going to do a primer on how us technical guys and girls can use fundamentals within the process like we do. So I think we'll all get something out of this because it's almost a mystery to me what he does. He just tells me I approve or don't approve the stocks, but I shoot him from a technical perspective. So you definitely want to tune into the next seminar. And again, Alex will send out the response cards. Give us new ideas for seminars. And please, if you want us to talk to you about your portfolio, then let us know. We sent out a newsletter today, by the way, so you can subscribe to the newsletter. And we did note at the bottom of the newsletter that we think that we're in the late stages of a bull market. That is not a bearish call, by the way. It's clear you don't have 200 years of upside. You get corrections. So we are due one, and it may not be for another year. But the point is that we do think the next number of years is going to be not quite a straight ride like it's been. And so we mentioned in the newsletter that it's the buy and hold investor. If you have an advisor almost everybody's done okay in this market. But what's going to happen is people are going to not do okay if the market does the inevitable. And the inevitable is it's going to pull back. It may take a year, but it absolutely must take a break. And in those circumstances, the traditional way of portfolio management doesn't work. So if you don't think you have an advisor, a portfolio manager or whatever that is prepared to take care of that kind of situation, then you may want to take a view of what we do. So as I said, everybody's a hero in a bull market. It's the bear markets that you prove your mettle. So anyways. We'll finish with that, and thank you for joining us.
Yeah, so the information for the next webinar, we'll send that out with the emails, and if you can also tune into the blog, we'll have information, newsletter, so it'll be everywhere, but we would like to hopefully see you next month, and thank you for tuning in.
Bye-bye.